Can someone give us an overview of what we did in our previous class? A quick one. Am I the only one in this class? Okay. Temilade Adeyemi. Right. Go ahead. I can't hear you. Maybe your network. Can hear you. Okay, that's fine. In today's class, we shall look at capital rationing under the capital investment class. What we'll do, we have decision tree, simulation, these two. I will not take that in class because I already have the video, right? I'll have to just add the video to, I will add it to the playlist, the FM playlist. If you check SFM, I think the last thing I did for them was on decision tree. I did decision tree and simulation. You check SFM playlist, you see simulation and decision tree. But there's no cost for now. I will just add it. I will add it to FM. I'm not, as far as I'm concerned, I'm not taking decision tree in this class and simulation. I'm taking capital rationing and replacement theory. After that, we move to business valuation, right? That is another interesting topic, business valuation. Now, what is capital rationing? Capital rationing is when company does not have a sufficient fund to finance a project that has a positive NPV. Meaning that a capital investment that will give you good cash flow, that will maximize shareholders' wealth, a company don't have the capacity to finance it. It could be that what they have, available resources that they have, is just 10,000 naira. If they have 10,000 naira as available resources, for them to execute that project, probably they have project A, project B, and project C. And they don't have enough. If project A, they have 100,000. Project A will cost 50. Project B will cost 50. Project C will cost 50. Total is 150. And what they have that is available is 100,000. And the project will give them a positive NPV. So meaning that they have to ration it. By looking for, they have to ration it by doing what we call allocation, because they don't have sufficient fund to finance the project. However, in rationing, we need to consider what we call mutually exclusive projects, dependent projects, independent projects, divisible projects, and indivisible projects. Class, listen. The question we stated as the project is divisible, the project is indivisible, the project is mutually exclusive, the project is dependent, and the project is independent. Now, we should not equally forget that at the beginning of our capital investment, part of the decision is what we call capital investment decision, where we have, as a project finance officer, you can make a decision on capital investment decision based on either mutually exclusive, either dependent or independent, or divisible or indivisible projects. Now, the question now is a quick recap on that. What is a mutually exclusive project? Is a project that serves the same purpose, meaning that if project A and project B will serve the same purpose, I don't need to execute the two when you are doing your capital rationing because they will still serve the same purpose. I can decide to go for A and leave B because they are mutually exclusive projects. What is dependent project? A dependent project is a project that depends on the other project, meaning that project A depends on project B, meaning that you cannot execute project A without project B. You cannot construct a road without drainage. Without what? A drainage, right? Meaning that when you are executing that project, you must do what? Consider the drainage as your project B. So it depends on each other. So they are dependent projects. You must execute them because they are important. They depend on one another. Why independent projects are projects that can be undertaken alone. Does not depend on any project. Does not depend on project C or project D. So when they say a project is independent, it stands on its own. What is divisible projects? Divisible projects are projects that cannot be undertaken in parts. You have 100,000 naira. You want to execute 3 projects that's worth 150,000. One of these projects is a divisible project. Divisible projects are projects that can be undertaken in parts, right? Meaning that because you don't have sufficient funds, you can decide to do part of the project. If you have a project of that worth 150,000, project A, project B, project C, and you just have 100,000, you can decide to do parts of any of these projects. If it is divisible, it can be undertaken in parts. Then we have what we call non-divisible projects. These are projects that cannot be undertaken in parts, meaning that if you don't have sufficient funds to execute that project, you will just leave it because they are non-divisible. Having explained this, we need to move to the causes of capital rationing. We have the soft capital rationing and the hard capital rationing. Why? Because when you don't have sufficient funds, why? It could be caused by soft or by hard. The soft may be caused by the internal factor within the control of the management, while the external factors, what will make them not to have a sufficient fund to finance the project, may be caused by external factor. So you can read this, it's in your notes, right? But my focus here is for you to understand the meaning of capital rationing, the process of capital rationing and the capital investment decision, which are divisible projects, non-divisible projects, dependent projects, and a mutually exclusive project. You see that decision, don't forget it at all, because in a question you may see it that this project is mutually exclusive or non-mutually exclusive. Now, how do we solve for capital rationing? In a situation whereby you don't have sufficient fund to finance that project, how do we solve for the capital rationing? Number one thing you need to do is to identify, even this number one is not even important, but however, it is also important. Identify the restriction. Sometimes in a question, they will tell you that, you see this project, whether it has a negative NPV or a positive NPV, you must undertake that project because it is important. Strategically, it is important. That number one may not be important, but calculate the net present value if not given to you, because you need to calculate the net present value. Number two, calculate the profitability index. Profitability index. This is very important. Index. Profitability index. Calculate the net present value if it is not given. Calculate the profitability index. Then when you want to calculate the profitability index, is equals to the net present value divided by the initial outlay, initial investment. We give you what we call profitability index, right? After that, you rank all the projects using the profitability index, meaning that your ranking, just like with the way we normally do under the theory of limiting factor or throughput accounting. You rank it, right? You do what? You rank based on the profitability index you calculate. Number five, you do your allocation. Allocation of fund that is available. Why do you want to do capital rationing? Is because you don't have sufficient fund to finance all the projects. You have to ration it. Then you now allocate the fund that is available based on your ranking. Then you determine the maximum net present value, right? You determine if a project does not require initial outlay in the year of restriction, it must be ranked first and select if it is not positive NPV. Leave that part. Leave that part for me, right? Just leave that number 6. When you do your allocation, you calculate your maximum NPV class. These are the steps you need to know. You calculate the NPV, you determine the profitability index, you rank. Sometime before you rank, or before you rank, you have to check the question. Sometimes they will tell you that this project, you need to rank it first. Strategically, it is important. Strategically, that project is important. Even if it will not come first in your ranking, even if it is not, even if it will not give you high profitability index, you must rank it first because they will tell you that it is strategically important for the management before you now do others. Then you now do allocation of funds. We'll look at that. Then lastly, you determine the maximum MPV. So having explained all this, we need to look at an illustration to buttress all our explanation on capital rationing. Right, capital rationing. Please, we can check illustration. I have two questions here under capital rationing. So let's quickly check illustration 10 on capital rationing. Are we there? So before we move to this calculation, right? So based on my little explanation now, do we have anyone that have question? A quick one so that we can move to the calculation. So you can mute your mic. A quick one, please. We don't have enough time because of our resources. So
I would like to ask, what do you mean by maximum MPV?
when we get there, you will understand the maximum MPV. Abib.
Okay.
It's not a problem. When you get there, you will understand the maximum MPV. Thank you.
So please, can you explain mutually exclusive project again? I didn't get that.
No.
But I got the rest.
No. I'm not supposed to even explain it again because I've explained it at the beginning of capital investment. Do you understand? So someone can do that. Please, who can explain the mutually exclusive?
These are really pointed nuggets.
Mutually exclusive projects are projects.
You said for they are projects that serve the same purpose.
Thank you.
Okay, thank you so much. Thank you.
Yeah, you're welcome. Omolara.
Yes, sir.
Do you have a question? You've seen your hand up here. It's a
No,
mistake,
it's a
right?
mistake. Yes.
So that's fine. Okay. So we need to move. Please, you should not forget the requirement of a question is very important. Don't just jump to capital investment. When you see it, maybe you see it as your number one question, or you see cost of capital. You need to be very, very careful. When you see any of these, because cost of capital is it is as important as capital investment. So let's assume you see it as your compulsory question. You need to understand the requirements. Understand the requirements. It is assumed that you've solved 60% of the question. Class, 60% of the question. So understand the requirement if there is no project-specific cost of capital in that question. Please always pay attention to the details. It's very important. When you see a question under the capital investment, right? When you see a question, you can read your soft and add. You can read all those ones, please. All those ones are not. So you can, if you see a question on capital investments, you should read the requirements very well and understand the examiner points before you jump to it. You should equally understand how the inflation is being applied. In our intensive class, for those who will continue with us with intensive, I'm I'm going to bring a question that we include the inflation. You don't have to inflate even from the first year. I have them. It is for intensive. There are some questions that they are for intensive purpose, so that they will not waste much of our time, right? We'll have like a week for that. So my question is that the application of your inflation rate depends on the question, not because I did like this in class. It will be like that. No, it is not static. It is the question that will tell you what you want to do. Class. Equally, when you see a question on objective of a financial manager, please read the question very well. Understand the requirements and the sources of finance. I've sent a note on sources of finance where you have the short term and the long term. Under the short term, where you have the bank overdraft, you have bank loan. Under the long term, when you have equity, when you have debt, when you have the right issue, public offer, when you have convertible, under debt, preference shares, all those things are very important. And Islamic finance, how to source for finance under the theory of Islamic finance is there in your notes. So the ball is in your court. You can decide to read or you ignore. Class. Now, the sources of finance, we may not even touch the sources of finance in normal class. Maybe I will just push that one to intensive as well. But we'll come back to working capital. That is the least that we will do. That is the last thing we will do, because working capital, most of you have the knowledge of working capital. So we need to move. We need to push what you don't have the knowledge at all in the financial management, which is business valuation. You will enjoy the class because it is purely practical. Now, who will read these requirements so that we can move? Who will read this question quickly? Fumilayo.
I'll read it.
Determine the best way to invest. Determine the best way to invest the available fund and calculate the MPV. A, if all projects are divisible. B, if none of the project is divisible.
Thank you. The question says, determine the best way of it. How do we now invest this fund? No, please.
Using both approach, divisible and non-divisible.
Now, meaning that how do we invest this fund that we have? How do we invest the fund? We have to calculate the MPV. If all projects are divisible, and if none of the project is divisible, means non-divisible projects. Class, what is the first step? Calculate your MPV. Step 2, calculate the profitability index. You rank the profitability index. Then you determine the maximum MPV after your allocation. Just like the way we normally do under the theory of throughput accounting and the limiting factor. It's still the same. Now, Ade Limited is considering investment proposals that have been submitted by divisional manager. They are considering investment proposal that have been submitted by divisional managers. The investment funds of the company are limited. This is what they have. are limited to 800. This 800 is what they want to invest. That is what they have. Class. That is what they have as their investments. They don't want to go, they don't want to do past themselves. They just have 800,000. And they've submitted 3 proposals. Details of 3 proposal investments, none of which can be delayed, are given below. Project 1. An investment of 300,000. This is what it will cost project 1, 300,000. To be made in power generation. Each generator would lead to labor savings in money terms. They've considered inflation in money terms to be this. Meaning that if they go ahead for these projects, they invest this, they will have a labor savings, a cash inflow of this. And this is the cost of the investment. And they have 800,000. You can see the first one is 800,000. Take note. Now, what is the second project? Project 2. An investment of 450 is to be made in individual power station for staff that is expected to reduce administration costs by 140,800 per annum in money term for the next 5 years. This is another cost of investment. Class 300 plus 450. What do we have?
750.
750. And they have 800,000 to invest. Why this will reduce administration costs? They will have a cost savings here as a result of embarking on these projects for the next 5 years. Project 3, an investment of 400,000 in new ticket machines, giving a net cash savings of 120,000 per annum in current terms. What does that mean in current terms?
Without inflation.
Without
Real cash
inflation.
flow.
Thank you.
Real cash flow.
The real cash flow.
The real cash flow. Now, class, you can see here you have the cost of the investment is 400,000. This is 300 plus 450. That is 750 plus 400. It is already above 800,000 that they have. So they have to do a capital rationing because they don't have sufficient fund. And this expected to increase by 3.6% per annum due to inflation during the first year of life of the machine. Can you see? Because this is in current terms, you have to inflate it by 3.6. When you inflate it, it becomes the money terms, right? For the next 5 years, right? Per annum. AD Limited has a money cost of capital of 12%. And taxation should be ignored. So money will goes with money. You cannot discount with money cost of capital. But in a situation whereby they give you real cost of capital here, you know you have to convert to money cost of capital, which I've given you the formula for the conversion. Now, determine the best way to invest the available funds and calculate the NPV. If all the projects are divisible, you can undertake them in parts. Why, if none? If you cannot undertake the project in parts, they want us to solve for this. How do we allocate the funds? That is capital rationing. The costs may be internal or external. Please, you can read that in your material. right? Thank you. So the first step, what is our first step? You calculate the NPV. So just a solution, since the NPV for each of the investment is not given. So we need to determine the NPV. So we start with project one. Project one, please pay attention. Project one, although this, so this will be at year 0. How many years? 1, 2, 3. How many years, class? 5 years. 5 years. Right. The first project have an initial investment. Initial investment. What is the initial investment?
For
Okay,
300,000.
300,000.
300,000. I can decide to do the format anyhow. Just present it. What is the name of the company? We don't forget
Ade
this.
Limited.
This is very important, please. Your structure, your presentation is very important, please. Very, very important. Determination of net present value. Right? This will give us 300. I can decide to jump this. We have the cash flow. The question has already said we should ignore the tax. We would have taxed this cash flow. What is the first cash flow, class?
We have 85.
85.
85. Where is Fumi?
90.
I'm here, sir.
Hey, please, I need you here, please. And Fumi and who self? Forgotten this person name. Rejoice.
Sir.
Then Kudus.
Yes, sir.
Are you still with us? I need to call my,
Yes, sir.
the babies first.
God when, God when.
So please, for me, figure and rejoice. Okay. Year 1 we have 85. Year 2, what do we have?
90.
We have 90. What do we have here?
95.
95. What do we have?
100.
100. Okay, thank you. So, and the project is for 5 years.
5 years.
Thank you.
95.
95. You can see that I put my Naira San here. You can see, can you see the way I present this? Now, the initial outlay is 300,000. So, if this is 400,000, okay. I can have 300,000, 85, 90, 100, and 95. Right? So I need to discount Using the money discounted rate given to us in this question, right? Using the money DCF given to us in this question. What is the money cost of capital? The DCF?
12%.
12%.
12%. This will be 1. This will be 0. What?
0.893.
0.89 what?
3.
Next.
0.797.
0.79. Next.
0.712.
0.712. Next.
0.636.
0.636. What do we have here?
We'll have 0.567.
0.567. So we can have the present value. We can have the present value. What do we have?
0.75. 76.
76. What do we have here?
That will be 72.
72. What do we have here?
68.
68. What do we have here?
That's 64.
64. What do we have here?
54.
54. Before you can before you can do a capital rationing, whether it is divisible or non-divisible, you need NPV if it is not given to you. That is the first step. So what will be the NPV?
34. Positive 34.
NPV is equals to 34,000 positive. So we move to the projects, to the calculation of project 2. We do the same thing, right? It may be different variables. Project 2. Project 2. Project 2. Right? Financial management is very simple. Please go and tell the people or the person that is saying it's too difficult. Please understand the logic, understand the principle behind it. That is why you are here with Next Gen Professional Associates. In our dictionary, we don't have any courses that is difficult, right? It only depends on the lecturer or the tutor that is taking you that particular topic or that particular course. And that is why we are Next Gen Professionals. So please be rest assured that you will pass your financial management, if and only if you follow the principle and the rule of the game. What is the rule of the game? You must not cover everything, but the main thing, you need to know them. Right? You need to know them. They are very important. Imagine someone wants to write financial management and the person did not understand cost of capital. You should even tell the person should go back. Even if you've paid, just go back. Because whether you like it or not, or whether village people like it or not, investment appraiser or cost of capital will be your number one compulsory question. Whether you like it or not, that is where you will see it. Then all other questions will follow, whether you like it or not. You can decide to say it will not be possible. Then we will now see. Class. The cash flow is to be reduced by 140,800 per annum. Per annum. So they will have a savings. They will have a savings in their cash flow. So they can have a savings, right? They will have a savings, and it is 140,000 watts. 140,000. 140,800.
800.
140,800. So you can call it a savings, right? Savings. Savings. Okay. Can have the savings. No. No. Okay. We can have this savings here, 140,800 per annum. Why this is 140? $140,000. Our focus is not on this calculation of adjusted present value. Remember, our focus is to how to ration, how to allocate the available funds of 800,000. Right? So we can have the same thing here, 140,800. 140,800. So we can have here 140,000. 140,000. 140,000. So what do we have? What will be the MPV? So this will be 480,000. $125,734. One what?
125.
125.
734.
734. What do we have here?
That's 112, 218.
112, 218.
218.
What do we have here?
100 to 250.
250. What do we have here?
89,549.
89,549. What do we have here?
79,834.
79,834. So this is 480. 480. Tolulope, are you still in this class? Net present value.
The initial investment is 450,000.
That is 450,000.
450,000.
The 4.
The initial investment for project 2 is 450,000.
Oh, it's 450. Oh, thank you. So what do we have as the MPV? What do we have as MPV? Quick one, quick one. What do we have?
We have 57,585.
57,000.
585. Positive.
57,585. So we quickly move to the next one. Project 3. Project 3. Project 3. Our focus is not all this calculation of MPV, but it is very important to calculate it. That is just it. It is very, very important. So what is it, project 3? What happened in project 3? There is an initial investment of 400 and there is net cash savings of 120,000 per annum in current terms, and this will increase by 3.6% per annum. You increase it per annum. So the initial cost of investment, net cash savings, cash savings. What is the next cash savings? What is the next cash savings? 120,000.
120 per annum.
120,000, right?
Yes, sir.
1,000 naira per annum. Okay. Project 3. 120,000. All right. 120,000. Imagine me, I'm supposed to be in where they are playing this music now. Chat. I'm in class. Or should I go there? But that's fine.
Accountants don't enjoy you.
That will be after
Enjoy.
after the diet. After the diet. We have 400,000. We have 400,000. So we have 400,000. Right. So please ignore the background noise. Just ignore it, please. 120,000.
You're not even hearing anything.
Really? Come on, now only me the feel here. 120,000. 120,000. 120,000. This is FCT. Even on Monday morning, they will still do party. They will do enjoyment now. They don't get worries. So what do we have here? What do we have here? A quick one, please.
We have 107, 160.
107, 160. What do we have here?
95, 640.
95, 640. What do we have here?
85,
What about the
440.
What do we have?
There's
85,
inflation.
440.
Oh, there is inflation.
But there's increases,
Let's
3.6%.
3.6% per annum.
Yes, for the first year. For the first year life of the machine.
No, it's per annum.
Everything.
Yeah, per year. It is per annum. Times 1.034, right? Is that not so? 1.3.
Yes, sir.
0.36.
Okay, well, increase it. The first year, increase it.
124,320.
124,000.
320.
124,320. What do you have here?
200. Oh.
Rejoice.
128,796.
The first one is what?
This one is correct.
Okay. What of this? Next.
128,796.
128,796. What do we have here?
133,433.
133,433. What do we have?
It's 133,432.
432, not 433, sir. 133,432.
Okay. What do we have here?
We have 138,237, 236.
138,
236.
236. What do we have here?
143,212.
143,
212.
143, 212. So I can copy this here. Meet your mic. Who is that now? So what do we have here?
That will be 111,018 naira.
111,
111 018.
018. What do we have here?
102,650.
650. What do we have here?
We have 95,004 naira. 95,004.
95
004.
Next, what do we have?
89,918.
89,
87 rather. 87,918.
87,918. So what do we have here?
81,201.
81,201.
201.
So what is the net present value? What is the net present value? What is the net present value?
77,791.
77,
791.
77,791. Okay, thank you. Now, after the calculation of NPV, don't forget that we are still in A, right? This is A. Okay. Before you can be able to know if all projects are divisible or non-divisible, you need to determine your NPV. The next step, you determine the profitability index. Profitability index for each of the projects is equals to net present value divided by the initial outlay or initial investments. So we have project 1, we have project 2, where we have project 3. So therefore, project 1, what is the net present value? What is the net present value for project 1?
We have 34,000.
34,000 watts, 34,000 naira. What is the initial outlay? Initial investment?
300,000.
300,000.
300,000. 300,000. right? So the next one, what is the net present value for project 2?
57,585.
57,585. What is the initial investment or initial outlay?
450,000.
450,000. Then project 3, we have 77,791. Then this is 400. Please, what do you have? What is your profitability index? What do you have?
11.33%.
11 or 0. What? 0.11,
Okay,
right?
0.1133. Yeah, let me just 11.
Okay, 11%. Okay, next, what do you have?
0.13.
0.13.
13.
Next, what do we have?
0.919.
0.19.
0.19. So we need to do the ranking. Rank. So which one are you going to rank first? If you are the project finance officer, you rank this first, right? Is that not so?
The third project 3.
Project 3, you rank this second.
Project 2.
Then you rank this the third based on the profitability index. The next step is to do allocation of funds. Allocation of funds based on the ranking class. In this ranking, in some question, class, listen, know, in some question, the question will tell you that even if the profitability index is 0.000 or minus 0.00, you must rank that project first. That is what we call restriction, because it is strategically important for the company. So in this question now, we don't have such projects. Maybe in our next question, we will have it. Class. So meaning that even if your profitability index that you right under the what? Under the limiting factor. So we can move allocation of funds. So what is the available resources? Available funds. How much do they have that is available? Available funds. How much do they have?
800,000.
800,000.
800,000. 800,000. Allocation. Allocation to project 3. Project 3. Now, project 3 will take initial investment. It will cost them 400,000 naira for the investments. So 400,000. What will be the MPV of that project 3? Let me say this will be your MPV. So the MPV for this project 3 is what? 77,791. So when you allocate for project 3, you will have available for projects 1 and 2. We have the difference to be 400 class. Then you now do allocation. Who are you allocating to? Project 2, right?
Yes, sir.
But we don't have sufficient capacity. to execute 100% of project 2, what we have is 400,000 naira. And the question says that A, if all the projects are divisible projects. Class, what is divisible projects? What is divisible project?
Projects that
Project
can
That
be
can be
executed in
undertaken
parts.
in parts.
Thank you. Now, we can undertake project 2 in parts because we don't have that sufficient fund to finance the whole project 2, but we will undertake it in part. We will take part of it. We don't have capacity to do the whole of this. So allocation to project 2 is 400. Now, how many percent will this give you if you will only invest 400,000? How many percent will you see? How many percent will now be the investments in project 2? What will be the percentage of investment? It will be the costs divided by 450,000. 450,000. Meaning that how many percent?
89%.
Meaning that you can only execute 89% of project 2. 89%. 89 of project 2. That is the only thing you can execute. You can only execute 89% only. And that is the reason why 89% will not give you that 400. Now, you cannot use the all this. You cannot maximize shareholders with the all of 57,585 because they don't have the capacity for everything. They can only undertake it in parts. So therefore, your NPV will now be 89%, 89 divided by 100 times, what is the NPV? 57%. Because that is only 89% they can execute. 585. What do we have?
That will give us 51,251 naira.
51,251. 251. This is a divisible project. This is the project you can undertake in parts. You can take this in full. You can take this one in part. That is the reason why they say if all projects are divisible. You can only undertake 89% of project 2, not everything. And you cannot just come and put the 57,585 here. No, because you can only execute 89%. Now, what will now be the 89% of the NPV? And this is what they will get if they invest the 400,000. So what will now be the maximum NPV? Abiodun, this is the maximum NPV that you can get from the project. What do we have?
129,042.
129,042. This is the maximum NPV. 129. This is the maximum NPV that you can get from this project if they are divisible. The next illustration is the B part of this question. Right? Is the B part of this question, which says that the B part of this question, none of the project is divisible, meaning that you cannot undertake that project in parts. You see, if you cannot undertake it in parts, just leave it because they are non-divisible. So we will start with allocation of our funds or funds available. Funds is 800. Oh, no space. No space. A minute. There should be a small space here, right? That we can manage. Because I need to go and meet. Okay, let's finish this class first. Now, allocation based on our ranking. Don't forget that they say if none of the project is divisible, you cannot undertake it in parts. Allocation to project 3. Project 3 is 400 as the investment. Then it will give us MPV, 100% MPV of 77,791. So the difference will be available for projects 1 and 2, 400,000. Class. After project 2, what is the next ranking? After project 3, sorry, what is the next ranking? Project 2, right?
Yes.
But we only have 400 and it will take them 450 to execute the project. And the question says none of the project is divisible, meaning that you cannot undertake it in part. Oh, if you cannot undertake it in part, what will you do to it? You leave it. So since you cannot undertake project 2 in parts, you have to leave it.
Project 1.
And
Not in project 1.
You have to leave it and move to project 1. Class, it is the requirement that will tell you what you will do. Don't be deceived by English. Understand the rule of the game is the principle. Don't forget, at the beginning of our lecture, I said I have all the secrets of FM, whether it is FM, whether it is SFM, whether it is P, or whether it is case. We have it here at Next Gen Professional Associates. But what you need to do is to pay attention. Is to pay attention to the details. You will know it. You will know it. Now, allocation to project 1. Because project 2, we cannot undertake project 2 in parts because of the question. So allocation to project 1. Project 1 need 300. Even if the project 1 is still 500, you cannot undertake it in parts. You will rather leave it like this and tell them that the maximum MPV is 77,791. Therefore, project 2 and project 1 cannot be it is non-divisible. But in this case, we have 300, we have 400. We can still move it. Project 1, 300, which will give us 34,000 MPV, right? So what is the difference?
100,000.
100,000, yeah.
So 100,000 will be the available. Available will be 100,000. So what will be the maximum MPV?
111,791.
Maximum MPV 100 and what? Sorry.
111,791.
111,791. Can you see, class? This is what we call maximum MPV. This is what you can get from the projects to maximize your shareholders' wealth. Remember, if you want to write like a professional, when you have a positive MPV, it indicates that the project will maximize the shareholders' wealth. Therefore, the project should be accepted, right? That is how we write if you are calculating it, right? So class, we are done with this question. So you can omit your mic, and that is why we are next gen professionals. You need to understand what you are doing. First, understand. If you understand, you can do and undo. Right? Thank you. You can unmute your mic, please. Salim. Our ladies first now, Abba. Ladies first.
Good evening, sir.
Good evening.
Okay, sir, my question is on project 3. We did 120 multiplied by 1.036.
Where did you see that one? Project what?
Project 3.
Where did you see 1.120? This is it. This side or
No,
the
no.
inflation?
Yes, the inflation part.
You understand this
So,
inflation now? We'll be treating inflation.
Yes, sorry, sir. I just want to ask that 120,000 multiplied by 1.036. Is it raised to power 2?
Anyone that you want to do. The first one, raise it to power of 1. The second one, raise to power of 2. Raise it to power of 3. Raise it to power of 4. Raise it to power of 5. Or I have alternative. I don't want to just use that one. I can tell you to say, as you have this answer now, multiply it by 1.036. You will still have this. Multiply it by 1.0, but don't use that method. Use this method, the one I taught you in class. Raise it to power for every of the year, because they say it is per annum. Because they say it is per annum. You can see we are following question. No, the question says it is per annum, so that is why we raise it per year.
Okay, thank you, sir.
You're welcome. Chinemere Miracle, sir.
Yeah, my question has been answered. The same question she asked now is what I wanted to ask. Thank you very much.
Well, it is the question. Oh, please go back to how to treat inflation, please. Thank you.
Thank
you. Bashirat.
Yeah, good evening, sir. Please, concerning the last question on the question you gave us on capital budgeting that you asked us to solve, I noticed in the question bank, in the inflation rates that they calculated, it wasn't increased in a yearly basis. They are just increasing it by the number of by the amount of by the percentage of the inflation They just
Yes.
increase it by that amount.
No, they raise it to power. Some, there are two
They
approach
didn't
to
raise
it.
it.
They raise it to. So how did they arrive? Go and check Rejoice. Check
They just
Rejoice.
use the amount that they
Check Rejoice. There are
the
two approach to it.
okay.
Bashir, listen. There are two approach to it. Maybe it is the second approach the person's use. But as far as I'm concerned, if you check Rejoice, you will see that she raised it to power of 1. She raised it to power of 2. You can check her own. Check it.
No, I understand the fact that she raised it in a power of 1, 2, and the likes. What I'm saying is the fact that in the question, in the format that they gave us, direct material and the likes, the variable cost, the format that they used, they didn't raise it by the number of power, and it has been inflated already. The figure that they gave us in the question.
Who tell you that it has been inflated, Bashirat? Okay, let's see now. Let's see.
It was then the question.
Wait. Just calm down. Do you have water there? Just read. Question what? Question what? So which question is that?
I want to check the question. I forgot the.
Okay, when you check. Next question, please. Next question. Next question.
Hello, sir.
Yeah.
Good evening. Thank you for today's class. Okay, my question goes this way. In a case scenario whereby, let's say all projects been equal except project 1 that have maybe a 3 years period, and the examiner asks us we should put years into consideration. So how do we go about
There is
it?
they don't put years into consideration. It is the project. Leave the lifespan of the project. If it is 5, if it is, leave the lifespan of the project. We are talking about the project itself, not the lifespan of that project. So follow instruction. Divisible and non-divisible. Mutually or dependent or independent projects. Thank you.
Sir, it's illustration 6.
Illustration 6. Okay.
Yes.
So what happened? They say they should restructure provide a revised
Redraft the revised this thing.
Yeah. So this, okay, they give us the selling. Okay, the selling price for, I understand what you're saying. They give us the selling price for this year. Is that not so?
Yes.
The selling price to be 25 naira per unit.
Yes, and the
Right?
volume of sales.
And the volume of sales. Listen,
Volume of
let's
sales.
check. Let's check.
Differs.
Let's check. It is expected that the selling inflation will be 4% per year. That is the inflation, right? Will be 4.2% per year. What they gave us to us is just the selling price, the normal selling price, without the effect of inflation. And we were told that it is 4.2%. So this will increase by 4.2% per year. I understand your point that when you have 4.2, you will have 1.04 to that. You should not raise it to power again. Since they've given you 25, they're giving you no. Since when you are considering inflation, you need to, although I understand your points, but just understand this, that this inflation, if in the case of, assuming the question says that the first 2 years, they will have this amount, then subsequently, inflation will take place. That is when that your thoughts will come in and tell you, that is where your thoughts will now come in, that other one, right? Assuming the question says that the first and the second year is this figure, then after that, you inflate it. Now, after that in that third year, that is where you will now say raised to power of 1. Because the question has already stated that you should leave it at this price in year 1 and year 2. But in a situation whereby you have something like this, it is per year. Inflation has not been considered. That price that you see there, it is just the normal selling price. Bashirat. However,
okay.
However, your point is well noted. Yes. Okay, you wanted to say something. Go ahead. But although we'll come back to it. But go ahead, quickly.
So what I'm saying in essence is that they gave us the real selling price, which is this 95, and the sales volume and in units, which has not been inflated. So looking at the format, the sales revenue, variable cost, and the likes, all these ones has been inflated. That's what I'm saying, that going by the calculation.
No, it has not been inflated. Did they say it has been inflated?
Yeah, they have not been inflated now. No,
this is it. The
above
above
that they have
selling
not been
price.
inflated. The above selling price and the variable cost are not inflated.
Have not been inflated. This is just the normal price. They are in
I'm not referring to the sales unit per year, or the 95,000 and the 25
I'm not
naira
referring
per
to
unit.
that
I'm
one
referring
as well. I'm referring to this. Both of us. I'm talking about this selling price.
Like, I'm referring to the format down after note. The above selling price and variable cost per unit have not been inflated. The format that they gave us, where we have the sales revenue.
All this sales revenue, variable cost, that means the one the junior staff did, like the sketch of what this junior staff did. That's what she's saying, that those ones have been inflated.
Okay. Okay, that's fine.
I'm referring to this format.
I'm coming. Leave their formats, Bashirat. What is the requirement? The requirement says that prepare a revised draft. Leave what they did. Right? Prepare a revised draft based on this information. Based on this information, leave what the junior accountant did and they revise it. Leave this information. Leave it. I know, I understand your point. I don't want to follow that route. I understand your point, right? But for understanding, just leave this. Then inflate according to information given to you. Relevant fixed costs are forecast to be 150,000 per year, 1 year, 2 year, 3 year, 4 years. And they said inflate it. Fixed cost inflation will be this per year. Follow this instruction. Leave what the junior accountant did up, right? Just leave that one. And that is the reason why they say you should provide a revised evaluation. Do you get?
Yes, thank you.
Did you get? Wait now. Which one is yes, thank you. Wait, did you understand it?
Yes.
Don't
you no come from your mind. You say yes.
That yes is not convincing though.
but that's fine. So Dari, quickly.
Please, I don't have the topic in my drive.
Is that?
It's me. I don't have the topic in my
drive. No, it's there
drive.
now. It's there now. Capital budgeting is in your drive, please. You can just search for it.
I did though.
Just search for capital budget. It's there. Right. You can just give it to someone to do it, or you just search capital budget in your Google Drive. Thank you. Dari, I will still come back to this. Dari. And wait, Bashirat.
Yes, sir.
Did you have textbook?
I didn't
Did you have
have.
okay. Okay, that's fine. Don't worry. Don't worry. I wanted to
And
say
please, under illustration 9 too, I've solved it, but there are concern on that question 9.
like, did you get it? Like, which
I
part did you
did
not understand?
I did it to some extent, but I felt the depreciation, I felt it's supposed to be deducted from the taxation, the calculation of taxation. I felt it's supposed to be imputed there, but that's not the way I did it. I did it exactly the way we did it in class, but I felt it's not correct. I don't know
Why? 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 Bashirat, why now? The
I'll
question
send the solution to the group so you check.
and send it. You can also compare with I think Rejoice and the other guy too. I think there are about two that did that. Is it not Olu PLC? It's one of the
Yes.
PM pass question. I think it's one of the PM pass question.
Olu Odin PLC.
PLC. You can check Rejoice, check our suggested
Check
solution.
November
Is that
2017.
correct?
Check November 2017 is there.
Yes,
November
she's
2017,
correct.
check PM is there.
So you should check. If you even check that Pathfinder, the suggested solution, I don't think you will even understand that suggested solution. That's just it. But I just wanted to like do it the way you will understand according to the question. Do you get? Just do it and share to the platform. Just do it and share. So I will look at it. Do you
I've
get?
done it. I'll send it right away.
Okay, no
sir,
problem. That's
which year in Pathfinder? So I'll go and look at it. Which year in Pathfinder?
why did you want to? Okay, I forgot.
November 2017 PM.
I don't think our
November
solution is
November
2017.
correct.
2017. Okay, okay. Thank you.
November
It has been
2017.
No, Wala, you're
serious
welcome.
for this, guys.
Okay,
Yes,
okay.
well.
But what is most important, class? What is most important is the process. Do you really understand the process? When you have a similar question, can you solve it? Right? We may have different answers because of the approximation sign. When I saw I said, okay, this is correct. And the presentation makes sense. We are good. Even if you check Pathfinder, the way they solve that thing, you will not even understand how they arrive at their answers, how they arrive at their figures. And that is the reason why next gen professional, we are different from, we don't use Pathfinder according to, no, we will solve it the way we understand so that you can go back and check. The same, it may not be, the process will not be the same, but we will still arrive at the same thing. We're talking about the same thing. So please, the process is very important, please. Thank you. Away. Emmanuel.
Okay, sir. Good evening, sir.
Good evening.
Sorry, only just an appeal. Something happened and I came into the class late. So please, I am pleading that after now you just help us and update the playlist so that we can go back to it. And
Mr. Emmanuel,
yes, sir.
As we speak now, go and check live. I don't need to upload anything. Check live. It's
okay,
there.
Sir.
Or you check playlist. Immediately after the class, just check it.
Okay, sir. Okay, thank you, sir.
Yeah, thank you. Tony.
Good evening, sir.
Yeah, good evening.
Yeah, still on that illustration 6. Note 8 there, the investment will be partly financed by 1.5 loan at 10% per annum. I want to
Illustration
know
what?
how it's going to be treated.
Illustration what?
Illustration 6.
So
Note 8. Additional
mm,
information 8.
mm, mm,
How will it be treated, sir?
uh-uh. Please, can someone explain
When
how
I was solving,
this point?
okay.
I'm coming. Can someone please explain how this 1.5 will be treated, please?
I think,
I know
sir,
that
excuse me.
it is an investment. Yes.
Go ahead.
Sir, I think that wait now, wait. I think that loan will not be included because it's not irrelevant. It's like no relevance to the project.
Okay. Thank you.
It is not relevant.
Next.
It's not relevant to the project. You cannot come and add it.
Thank you. Next.
Yeah,
Who
I
want to
felt
explain
it
that?
will I felt it will not be considered because it's a finance cost, so it's not relevant to the computation of this thing.
Thank you. Any other observation? So the other person, Tony, sorry, what did you feel this investment should be? Probably we can
I
learn.
know it's an investment.
Okay.
Then the fact that is going to be on 10% per year. I thought we are supposed to calculate it the way we calculated the working capital.
Okay.
Since
No.
it's being used to finance the investment.
No. Do you know why? Because this is in another case, maybe in SFM, there is a topic called adjusted present value. It is that one that consider all the sources of finance. If you have investments, will be partly financed by 1.5 million loan, then they will not pay 10% per year. Anything that has to do with loan, it is assumed that you've used it to calculate, they've used it to determine their weighted average costs. They've used it to determine their what? Their weighted average what? Their weighted average cost of capital. Are we still together? Are we still together, please?
Yes, sir. Please
Yes.
explain that one
So
because
it is
even my
just
own self, I wrote two answers there. I was not sure if we had to use it. I was thinking probably it's just the interest that we're not supposed to use when we are
if
solving for.
it is like the normal value of the loan. If the value of the loan is 1.5 and you are to pay interest on it, which is 10% per annum, right? So it will not be considered, please, because you've used it to determine the weighted average. This is the cost of debt. This is the value. You've used it already. And already the cost of the machine is 1.8 million. So why do you want to use it? Have I answered your question, please?
Yes, sir.
Hello. Okay. So are we good now? Are we good now?
Sir, please, for question 7, that's part of the variable
Yeah,
cost.
thank you, sir.
Thank you.
Question
So
7.
I'm coming. Oh, so
Sorry.
this part of capital rationing is cleared, right? We are good. Now your assignments.
No,
Wait,
sir. I have a question. Okay.
go ahead.
Okay. Sorry, sir. Please. For that B part, for the non, that is for the project that is not divisible. What if project 2 is divisible and project 1 is not divisible? How do we treat that?
You treat it based on the allocation, whether it is divisible or not divisible.
Okay,
You
sir.
treat
Thank
it
you
the
so
way
much.
we normally treat. So it doesn't change. It is still the same process. If the project 2 is non-divisible, leave it now. You will not execute it. You just leave it. They tell you that it is not non-divisible. Leave it. You move on to the next one.
Okay, sir. Thank you.
Yeah, welcome. Any other question?
Sir, please, that illustration 7 concerning that variable cost. Are we to do the MPV separately? I don't understand. Please check, sir.
Illustration
7.
Okay, I'll check it now. Chineme Miracle.
Yeah. Sorry, it's a follow-up to what the last person asked about divisible and indivisible. What if in a situation where we have dependable and after dependable project and after calculating like we have just done now, we found out that some of the money cannot complete the available amount
We'll leave
cannot
it.
go around.
We'll leave it.
I'm talking of so we leave dependable as
yes.
We leave it.
Yes, we leave it now. That is if it is dependent, if it is dependent project, A depend on B.
Dependable.
You must do the A and B.
Yes.
But if you can do A, you can't do B, you have to remove it. You have to remove it because they don't have sufficient fund to do the two projects. So it is better you just remove the two. So it's still the same process. It doesn't change.
If you want to go clarification. Thank you. Thank you very much.
You said what?
Thank
you. Okay, that's fine. That's fine.
I said thank you very much.
Yeah, welcome. Welcome. That's fine. So I will check. I will check question 7, Abi Bashirat. Is it question 6 or question 7? Bashirat.
Question 7, sir.
Okay.
Because even in that question 7 too, there was no discounted cash flow, like no cost of capital to use.
So I think they expected us to calculate the expected
value.
Expected value. Yes. I now felt maybe we have to do the strong net present value separate, moderate and weak separate. So then we now compare the expected value. I don't know.
Keep thinking. Oh, you have to know. This is 20 marks question. This is 20 marks question. You have to know. I'll go back. I'll check it now. I would just want to give you.
Hadn't been his normal expected value, would have solved it separately, but like is in between questions, so I don't know how to go about it.
I'm coming. I will check it now shortly. I will explain that part now. I will explain. Should just please hold on. I think Vivian. Okay, Vivian. Please go ahead.
Hello, sir. Good evening, sir.
Yeah, good
I just
evening.
wanted to ask a question on the capital rationing we just worked on. So my question is, in a real life scenario, right? So which of these options are advisable? Is it like carrying on a project when it is divisible or when it is not divisible? So do we use the NPV as a guide as to knowing the conclusion or the
Yes.
decision to
Yes. Yes.
okay.
MPV is in project finance. MPV is important, is as important as anything. Practically, let's say in a construction company, you have to undertake, they have to construct a road or bridge. It is a project, it is a capital investment project, right? Now, at the same time, they have to do a drainage. It is a capital investment project. Now, meaning that when you construct that bridge, drainage, of course, is important. Meaning that A depends on the B. So the MPV will be used as the basis of computation because a positive MPV indicates that the project will maximize shareholders' wealth, meaning that it will create a wealth. Shareholders will generate more cash inflow from that project. We should not equally forget that as a project finance officer, you are projecting that it's just like you want to build up a model from scratch. Just like you want to prepare a financial statement from scratch, where company did not have records. You need to start from the bank statement, from the scratch, to analyze the sales, the payables, the receivables, the assets, this, and that. The same thing applicable to financial modeling. You need to we started from scratch by doing a research. What would be the selling price? Maybe in a construction now, they want to maybe in a construction or three unit or 4 bedroom, right? Now, what will be the going rate? Or yes, what will be the going rate? You need to forecast what it will be by including inflation, because those money are for investors. They want you should have considered inflation before telling them that they should invest in this project. Not that when you want to pay them, you now say, remove this, you have this. No, they expect you to have considered the inflation. Then what do they have? And what is available? It is what is available for the what? For the investors, for them to share. I've been in a space of what is it called? In investments, where real estate, whereby we have to project what will be the going rates, because the investors want to buy the plaza. Then we need to look at, okay, what is the expectation? What the investors is expecting from this particular investment. We have to do that and say, oh, this year the rent will be 2 million. Next year it should increase to 3 million because of the value, and it is in a strategic location. The increment, you will be the one to do your research and indicate that, okay, the inflation should be this, because we don't know what inflation will be at the end of 2025. So while you are building up a project, you need to do a research and understand the macro economy so that you can be able to effect that. Although we should not be expecting 100% perfection on it, but at least it should be like, at least we should be close to what investors are actually expecting from their investment. So in practice, it is applicable whereby a company may not have sufficient funds, most especially in project finance. They don't have enough capacity. They have like 4 projects to 5 projects. Then you will now see them borrowing You will not see them borrowing. Now, when they borrow, and that will now take us to another part of NPV, which is adjusted present value, where you will now consider the sources of finance, where they borrow that money, maybe from the bank, equity, and debt. That is another part, right? But in this aspect here, we don't consider the finance. We only consider the relevant what? The relevant costs. Right? Then we do the allocation based on how they are divisible, how they are important to us. Divisible. There are some projects that strategically, even if the project is zero, they must undertake it because with that project, they will have a competitive advantage. Right? They will have a competitive advantage. It's just like it is any capital investment. We should look at it in the perspective of that, right? That they need to execute it because that will give them it's just like upcoming construction company that are just coming up, right? They need to execute this project to give them more edge against, or to just give them more opportunity than others, right? So it is applicable in practice, right? So whether it is divisible or non-divisible projects. Thank you.
Thank you, sir.
Thank you. So are we good?
Sir,
Now,
please do
assignment.
illustration 7.
Okay, yes. So assignment. This question is also on divisible and non-divisible projects. But I will solve the B part of the question, but you can also attempt it. That will be in our next class. But your assignment is for you to calculate the NPV. Calculate the NPV of E. Please, I will not come to this class and calculate NPV again. No. Calculate the nominal after tax of value of NPV and comment on the acceptability of the project. Please calculate it. Then our focus in our next class is just on this. I will just come and calculate the what is it called? The maximum NPV using all the variables given to us, whether it is divisible and mutually. For those who are asking for mutually exclusive, is here, right? We have it here, right? So now next class we look at about this A part of this question. You need to go and calculate it, which is project E. Class, are we still together, please?
Sir.
11. Illustration 11. Ma?
Yeah.
Okay, that's fine. Now, illustration 11, please don't forget this. Question A. Please solve it. Maximum NPV. The E. In fact, I have the suggested solution for this E itself. I think I did. I solved it in SFM class, right? I think I can share it, but just I know you can do it now. Project E is still the normal, the usual way. Please solve and share your suggested solution. Thank you. Class. Our next, we still have replacement theory. Replacement theory, simulation, and decision tree. I will take replacement theory in our next class. Decision tree and simulation. I've done that already. I will copy what I have in SFM, the class, the recording. Copy it and join what is it called? FM. So we don't need to take that class again. That is waste of time and even resources itself. Decision tree and simulation. There's no how you will watch that video. You will not understand simulation or decision tree. It is not possible because after that class, I asked SFM student, did they understand? They say yes. No, business valuation, we'll take business valuation. After everything, we'll take business valuation. I asked SFM students, they say yes. About 50 of them, they say yes. So there's no how you will watch that video on simulation and decision tree. You will not understand decision tree or simulation. I will add the two to the playlist so that you can go and watch. But in our next class, our focus will be on replacement theory. I know some of you will say, what about lease? What about lease? Lease, we'll do lease in our intensive class. That will be lease. Right? To the Google Drive, okay? You can check your mail. If you pay for the material, check your Google Drive. Check your Google Drive, you'll see, yes, you'll see the material there. Thank you. So class. Thank you. So class, our next class is on Saturday. We will have 2 classes. The first class is at 5 p.m., 5 to 7. Second lecture will commence 8:30 to 11. So please get yourself prepared. Then in our class, we'll be able to complete the replacement theory and introduce business valuation. Business valuation will just take us 3 classes. Very simple. You will understand it easily, right? If you can comprehend the cost of capital, what is the evaluation? So, thank you, everyone, and see you on Saturday. Then this part of variable costs, what you should do is to determine the expected value. You multiply this by this. You multiply this by this. You multiply this by this. You get your expected value. And don't forget that they say the variable costs in the forecast are before taking account of variable cost inflation of this. So when you get the expected value of moderate, strong, and weak, add everything together. That will be your expected variable cost per unit. Then that your expected variable cost per unit inflated by 4% per year. So that is it. So I think we have to go now. This is 11.
Sir, that's what
Sorry,
I
sir,
did.
you said
There,
we
so
should
if I'm
multiply
correct.
what? You said we should multiply what?
I multiplied the
Please come again.
probability
Oh.
percentage with the variable cost per unit. So I now sum everything together, the strong, moderate, and the weak.
Yes.
So I sum it
Yes.
together. And I now tagged it as my variable cost per unit.
Per
So I
unit.
got 12 naira per unit. So I now use it to multiply the
Inflate it.
quantity that, yes, inflate it by the total that we have as the sales volume and sales price per unit.
No, this is what you will do. One after the other, please. You use 4.5 to multiply 10.8. 3.5% to multiply 2. 20% to multiply 4. Add everything together. You have expected variable cost per unit. then that expected variable cost per unit, you will now inflate it by 4% per year times your sales volume will give you the variable cost. So they just want you to unlock these jargons that is here.
That's what I did.
So on that note, I think we have to go. Please take notes. If it is money, money goes with money, real goes with real. That is very important. Right.
But there was no cost of capital for this question.
Okay, let me check now. But what if there is cost of capital? What if there is cost of capital?
There isn't.
I'm coming. There is selling price, not just blah 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 blah. Okay, that's fine. I'll check what happened. I'll check. So, thank you so much, everyone. Remember, financial management is very simple. You will pass your financial management, understand the principle, and that is the rule of the game. And that is the strategy. The strategy is that pick what is important. Imagine center taking PM. They forget to take relevant costs, limiting factor, and throughput. Hey, remember,
Very, very risky.
You in financial management, you are taking financial management without cost of capital or investment. Cost of capital and investment are priced together. They are as important as anything. So please, there's no how you will watch that video that is on YouTube. You don't understand cost of capital unless if your village people do your back. Unless we tell your village people to go back. Is that not so class? So thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you, and bye for now. Thank you, everyone. Thank you.